August 19th, 2025, 10:14 a.m., $337,000. That was the equity Theo Patterson had in his own house that morning. 17 years of slow gain, about to evaporate on a courthouse sidewalk in Jacksonville, Florida. A man in khakis bought Theo's house for $442,000 at auction. Cash. One signature, 2.5 years earlier. Gone. 2.5 years earlier, Theo had signed a single sheet of paper in the parking lot of a credit union. His younger brother sat beside him. The loan was $18,000. How does an $18,000 loan, one he never spent a dollar of, unwind into losing the house? The Federal Trade Commission has estimated in its long-standing cosigner guidance that as many as 3 out of every 4 cosigners on a defaulted loan end up paying some portion of the balance. 75%. But most of them have never read the one-page cosigner's notice that federal law requires the lender to provide before a signature. This is Theo's story. It's drawn from patterns documented in FTC filings, Federal Reserve research, and reported cosigner cases. And it starts the way these stories always start. A brother asked for a favor. Theo Patterson was 42 years old, a construction foreman at a commercial contractor in Jacksonville, Florida. He pulled in about $78,000 a year, plus overtime during hurricane season. His wife, Danielle, ran the billing department at a dental office. They had a daughter in 9th grade. They had a 3-bedroom house on a cul-de-sac in Mandarin, bought in 2008 for $215,000 and refinanced once in 2019. By January 2023, the house was worth about $485,000. They owed $148,000 on the mortgage. $337,000 in equity, a slow, quiet win built over 17 years of payments. You know what that equity represents, right? It's vacations they didn't take, used cars instead of new. It's decisions. Theo's younger brother Dean was 38, recently divorced, a line cook at a Mexican restaurant on Beach Boulevard. He wanted to open a food truck, Tacos al Pastor, a used kitchen trailer he'd found in Georgia for $12,000. Truck, permit, insurance, supply run, $18,000 total. Dean's credit score was 584. No bank would touch him. Not Wells Fargo, not Suncoast Credit Union, not even the subprime personal loan companies that advertised on late-night radio. He'd been denied 6 times. Then one Sunday afternoon in January, Dean came over with a printout from an online personal loan platform. Pre-approved at 19.99%, but only with a qualified cosigner. I just need your signature, man. That's it. I'm not asking you for money. Just the signature. Theo signed the paperwork 3 days later. A 54-month term. Monthly payment $392. Total repayment $21,168. Dean hugged him in the parking lot of the credit union. He cried a little. He said he wouldn't forget this. For the first 6 months, Dean paid on time. The food truck actually opened. Theo and Danielle drove down to Atlantic Beach on a Saturday in April to eat tacos in a parking lot. It was, for a moment, everything Dean had promised. Then August 2023, missed payment 1. Dean called Theo. The generator had gone out. Repair was $1,100. He was already covered for September. He just needed October. October passed. November passed. Dean stopped answering his phone. Research published by the Federal Reserve and others on cosigned loans has consistently shown the same pattern. Loans that require a cosigner default at meaningfully higher rates than loans that don't. The reason is simple. A cosigner is usually requested precisely because the primary borrower couldn't qualify a loan. But most cosigners don't think of themselves as underwriting a high-risk loan. They think of themselves as helping someone they love. In December 2023, Theo drove to Dean's apartment in Arlington. The apartment was empty. Keys were in the mailbox. A neighbor said Dean had moved to Tennessee. Theo called their mother. Their mother didn't know either. Dean had given her the same story. Just getting some space. No address. A prepaid phone that went to voicemail. By January 2024, the loan balance was $19,472. Late fees, default interest, collection costs. The lender wasn't calling Dean anymore. They were calling Theo. What would you do? You've got a mortgage, a daughter, a wife, a job. The loan is almost $20,000. You don't have $20,000 sitting in an account. Theo did what most cosigners do. He tried to pay the minimum, $418 a month, out of his own checking, almost 11% of his take-home pay. Danielle saw it on the joint account the first month. "We can't just absorb this, Theo. This is our daughter's college money." They fought for 3 days. Then they agreed to keep paying while Theo kept trying to find Dean. He called 2 of Dean's old friends. He drove back up to the Arlington apartment. He even checked his mother's house in St. Augustine twice, hoping Dean had shown up there. Nothing. He kept telling himself next month. Because lawyering up meant admitting it was over. That meant accepting Dean wasn't coming back. Every month he paid the minimum was another month he could tell himself his brother might still call. By March 2024, Theo's credit score, which had been 754 when he signed, had dropped to 522. Under the Fair Credit Reporting Act, a cosigner's payment history is generally reported the same way as the primary borrower's. Every late payment, every collection note, it flows to the cosigner's credit file as if the loan were theirs. In the Bureau's eyes, Theo wasn't a safety net in the background. He was a borrower. The consequences stacked fast. Danielle's car lease renewal was denied. Their homeowner's insurance rate climbed. An auto loan Theo had been paying since 2021, his work truck, triggered a universal default clause that raised the rate from 6.9% to 29.24%. In the spring, Theo stopped the $418 payments. He couldn't afford them and the family's other bills at the same time. The lender began the standard collections path: call letters, notice of default, then a summons. In July 2024, the original lender sold Theo's account to a collection law firm in Atlanta. The firm sued. Theo missed the response deadline because the summons was served at an old P.O. box he hadn't checked in 4 months. A default judgment was entered on October 11, 2024. The judgment was for $24,180. Original principal, accumulated interest, late fees, attorney fees, and court costs. Theo did not know this at the time, but the day that judgment was entered, the clock on his house started ticking. In December 2024, the collection firm filed a judgment lien against the Patterson home. Florida is a judicial foreclosure state. In Florida, a recorded judgment lien can attach to real property and, depending on the lien's size and how the creditor proceeds, can eventually lead to a forced sale. Here's the piece most homeowners never look at. Theo's 2019 refinance agreement, a dense 72-page document he had signed without reading line by line, contained a material adverse change clause, a provision his loan officer had described at closing as standard language, nothing to worry about. In practice, that clause gave the servicer an option. A substantial judgment lien filed against the property could be treated as a default event under the mortgage. So once the lien hit, Theo's mortgage was also flagged as impaired, even though he had never missed a mortgage payment in 17 years. Theo called a lawyer. The lawyer wanted a $4,000 retainer. Theo didn't have $4,000. The lawyer explained, free of charge, what was about to happen. Your best move is to sell the house voluntarily, pay off the judgment at closing, take what equity's left, walk away. Theo listed the house on January 11, 2025. Asking price $492,000. He had 4 showings in the first week. A cash offer for $468,000 came in on the 10th day. And then, because this is how these stories go, the title search turned up the lien. The buyer's lender wouldn't clear financing. The deal fell apart. By March, the mortgage servicer had formally accelerated the loan. Foreclosure proceedings began. Theo tried to refinance to consolidate, denied, credit score 489. He tried a hardship program, denied, the default had already been formalized. He tried short sale approval. The servicer refused because the judgment creditor had first priority on any proceeds above the mortgage balance. The foreclosure auction was scheduled for August 19, 2025. Florida remains one of the highest volume judicial foreclosure states in the country. Consumer advocacy groups and legal aid organizations have long flagged cosigner liability cases as one of the hardest categories to unwind once a judgment lien is filed. The most successful interventions generally happen in the window between the cosigner agreement and the primary borrower's first missed payment. Few people act in that window. Theo and Danielle moved out on August 18, 2025. They rented a 2-bedroom apartment near Danielle's sister's place in Orange Park. It was $600 a month more than their mortgage had been. The next morning, Theo drove to the Duval County Courthouse. He didn't have to be there, but he wanted to see it. A man in khakis, Theo later learned he was a real estate investor from Miami Beach, bought the house for $442,000 in cash, roughly $43,000 below its estimated value, because auction sales trade at a discount. From that $442,000, the court distributed $163,000 to the mortgage servicer, remaining principal, accrued interest through acceleration and servicing fees, $27,800 to the judgment creditor, $11,900 in property taxes past due, $19,000 in foreclosure legal fees, $10,000 in auctioneer and administrative costs. Theo walked away with $210,300. His equity on the morning of the auction had been $337,000. He walked away with a check for just over $210,000, more than $126,000 of equity, and a house he'd paid down for 17 years evaporated because his brother stopped answering a phone. He has not heard from Dean since. There are 4 things Theo didn't know that day in the credit union parking lot. Any one of them could have changed the ending. 16 CFR 404.3 under the Federal Trade Commission's Credit Practices Rule. For loans from creditors covered by the rule, the lender is required to give you a specific standalone cosigner's notice before you sign. 1 page. Plain language. You are being asked to guarantee this debt. Think carefully before you do. If the borrower doesn't pay the debt, you will have to. If that notice isn't provided, the FTC can take enforcement action against the lender. In some cases, it can also support a consumer's defense in court. It will not always void the underlying contract. Courts treat it as a factor, not a kill switch. But a paper trail of a missing notice is one of the most important pieces of documentation a cosigner can preserve. Certain private lenders offer a release clause in the back pages of the agreement. After a set period of on-time primary borrower payments, commonly 12 to 24 consecutive months, the cosigner can apply to be removed from the loan if the primary borrower now qualifies a loan. Federal student loans generally do not have this. Some private personal lenders do. The lesson here isn't that Theo could have escaped Dean's specific default. Dean missed before any release threshold would have hit. The lesson is that before you sign any cosigner agreement, you check whether a release clause exists and what its trigger is. If the loan has no release clause at all, the cosigner is on that loan forever. That is a different conversation to have with the primary borrower before the signature, not after. Under general contract law principles, once a cosigner pays a defaulted debt, they may have a claim against the primary borrower for reimbursement. In many states, that claim stays open for years from the date of payment. Theo could still sue Dean, but only if he can find him. Behavioral researchers, including Robert Cialdini in his work on social influence, have long argued that when a close family member asks for a favor, the part of the brain that calculates risk gets quieter, and the part that protects the relationship gets louder. That framing has been extended to cosigner requests. You don't evaluate a cosigner pitch the way you would evaluate a lottery ticket with the same odds. You evaluate it as a family test, and the cost of saying no feels, in the moment, much higher than the cost of signing. Research over the years on cosigner outcomes has consistently suggested the same underlying gap. Cosigners, at the moment of signing, tend to believe the probability of default is far lower than what the data actually shows. I'll be honest with you, this is the story that made me change the financial planning conversation I have with my own family. Not about how much to save, not about index funds. About this specific question: what would you do if your brother asked you to co-sign? If someone in your life has asked you to co-sign a loan, or is about to, do these 5 things before you put pen to paper. 1. Ask the lender for the cosigner's notice, not a brochure. The 1-page notice required under 16 CFR 444.3 for covered loans. Take a photo of it. Keep it. 2. Read the agreement for a cosigner release clause. Ask how many on-time payments trigger it and what paperwork the release requires. If there is no release clause, the loan is forever. 3. Check the mortgage or deed on your own home for a material adverse change clause. You don't have to understand the language yourself. Call a real estate attorney or the servicer's customer service line. Read them the clause and ask one question. Can a judgment lien filed against me trigger a default on this mortgage? That's the line that can put your home at risk. 4. Write a private dated contribution agreement with the primary borrower. It won't impress the lender, but it will protect your right to sue for reimbursement later if the loan defaults and the primary borrower ever surfaces again. 5. Ask yourself, in your own handwriting, one question. Can I afford to pay every cent of this loan if the primary borrower vanishes tomorrow? If the answer isn't yes, the signature was never worth it. Drop it in the comments. Has anyone ever asked you to co-sign? Did you sign? I read every single one of these. The patterns in those replies are the entire reason I make these stories. If this one made you think of someone who's about to sign for a family member, send it to them tonight. Before, not after. Subscribe. A new story like this every week. That's all.